Hey everyone, and welcome to The Explainer. Today, we're looking at a high-stakes strategy guide that honestly could completely change the game for your operations finances. We're going to break down the absolute best ways to acquire heavy machinery without entirely crushing your operating cash flow. So whether you're running a massive farm or a busy construction firm, let's dive right into this playbook.
I want to kick things off with a bit of a crazy question. What if I told you that $1 million tractor or that huge piece of earth-moving equipment actually costs just a fraction of the sticker price? Now, I know it sounds like a total gimmick, but I assure you it's not. If you hook into the right financial structuring and really weaponize the latest tax codes, you can drastically alter your bottom line. We are definitely going to challenge some assumptions you might have about the true cost of modern gear. So, here is our game plan for today. First, we'll hit the heavy equipment dilemma. Then, lease versus buy. Third, the custom hire alternative. After that, we get into the really fun stuff, maximizing Section 179, followed by the bonus depreciation combo. And finally, making your final choice.
All right, let's jump straight into Section 1, the equipment dilemma. High costs versus cash flow.
Look, we all know the reality on the ground, right? Modern machinery is just wildly expensive. Getting top-tier equipment from powerhouse brands like John Deere or Case Construction, those are massive, critical investments. But here's the catch-22. If you aren't strategic about it, these machines threaten to absolutely destroy your operating cash flow. I mean, you literally need these tools to grow your business, but tying up all your available capital in a single piece of iron, that's incredibly risky. Finding the right financial pathway isn't just about getting the keys to a machine. It is about protecting the lifeblood of your entire business. Moving right along to Section 2, lease versus buy, choosing your path. Okay, let's unpack this a bit, because the word lease actually covers two very different financial tools, and knowing the difference is super crucial. First up, we have the operating lease. This is what you'd call a true lease. You essentially rent the equipment for a set period, usually with much lower payments, and at the end of the term, you just walk away or upgrade, no strings attached. On the flip side, we have the finance lease. Now, the IRS actually treats a finance lease as a conditional sales contract. It's essentially an installment loan with a balloon payment at the end, and it's designed for you to eventually take ownership and build equity. And really, this brings us to a core operational choice. The big advantage of leasing is all about capital preservation. You're looking at lower upfront costs, really predictable cash flow, and hey, you can easily upgrade to the latest tech without worrying about your machine becoming obsolete in 5 years. But buying? Buying is all about pride of ownership. You build hard equity on your balance sheet, you have absolutely 0 hour limits to stress over, and, as we'll see in just a minute, buying unlocks some massive tax incentives. All right, Section 3, custom hire, the zero capital option.
Now, this is where things get really interesting, because it basically pits complete control against complete flexibility. Think about it. When you own your machinery, you control the schedule entirely. You decide the exact day, the exact hour the work gets done, and you oversee the quality. But you hold all the capital risk, plus all those lovely repair costs. Custom hiring completely flips the script. It requires 0 capital investment in machinery and 0 repair costs. Plus, the machine actually comes with an operator. So if your operation is dealing with a tight labor supply, which so many are right now, letting a custom operator run their own gear while you manage other logistics is an incredibly smart pivot. And if you're sitting there thinking, well, custom hiring is just a niche solution, check out this fact from Iowa State University. Custom operators harvest approximately 30% of all the crop acres in Iowa. 30%, that is huge. It just goes to show it's a wildly popular and effective strategy to match costs exactly to the acres you work, without taking on a single drop of long-term debt. Okay, this leads us perfectly into Section 4, maximizing Section 179 and weaponizing those tax codes. This is the part I love, because it's where we take the 2026 tax codes and put them to work for you. It turns out, these IRS tax rules, they aren't just dry, boring accounting trivia. They are highly strategic tools that can literally save you hundreds of thousands of dollars. They can drastically alter what you actually pay out of pocket for your equipment. Section 179 basically allows you to expense the full purchase price of qualifying equipment in the exact year you place it in service, instead of slowly, painfully depreciating it over and over. Just look at the sheer scale of this. For the 2026 tax year, the Section 179 maximum deduction sits at $2.56 million. And yes, that applies to both new and used equipment. It gives you just an incredible amount of control, because you get to choose exactly which assets to expense so you can hit your specific taxable income targets.
Now, a quick heads up, there is a phase-out threshold that kicks in at $4.09 million of total equipment purchased, and it fully phases out at $6.65 million. Also, keep in mind, Section 179 cannot create a net operating loss. It is limited by your business's taxable income.
Which brings us to Section 5, bonus depreciation, the ultimate combo.
So the really crucial point here is that for 2026, bonus depreciation has been fully reinstated to 100% for qualified new and used property. And here's the kicker. Unlike Section 179, bonus depreciation doesn't have an overall dollar cap, and it actually can be used to create or increase a net operating loss. That offers you massive flexibility. So, how do we actually stack these together? Well, the IRS requires a very specific order of operations here. Step 1. You apply Section 179 to your highest priority assets to selectively lower your taxable income. Step 2. You apply that 100% bonus depreciation to whatever is left over, the remaining eligible basis. This combination is, frankly, the ultimate financial cheat code for maximizing your first-year tax write-offs. Let's look at a concrete calculation provided by U.S. Bank to show you exactly how this works in the real world. Imagine you buy $3 million worth of equipment in 2026. First, you take your maximum Section 179 deduction of $2.56 million. Boom. That leaves you with $440,000. Next, you apply your 100% bonus depreciation to deduct that remaining $440,000. You have now just deducted the entire $3 million purchase in year one. If we assume a 21% C Corp tax bracket, your actual cash savings on this purchase is $630,000. So that effectively drops your net cost of a $3 million equipment investment all the way down to $2.37 million. See, this is exactly what I meant earlier when I asked if you wanted to buy a tractor for a fraction of the price. Finally, we've reached Section 6, making your final choice, the action plan. So, to wrap this all up in a neat bow, here are your big takeaways. First, you absolutely have to match your financing to your cash flow needs. Remember, true leases are basically just rental expenses, but purchasing or using a finance lease, that is what unlocks those massive Section 179 and bonus depreciation codes. Oh, and definitely verify your state's tax conformity, because state laws can vary, and always consult your tax advisor to perfectly coordinate all of this with your income. So, here's what I want to leave you with today. Are you going to let old habits and traditional thinking drain your cash flow, or will you use this playbook to strategically finance your next big upgrade? You now have the inside track on how operating leases, custom hiring, and those staggering 2026 tax codes can completely transform your heavy equipment costs. The tools are literally right in front of you, so it's time to call your accountant, have a chat with your local dealer, and make your money work exactly as hard as your machinery does. Keep learning, keep growing, and I will see you on the next explainer.